The broadcast is now starting. All attendees are in listen-only mode.
Good morning. Welcome to today's webinar, Impacts of COVID-19 on Currency Volatility. My name is Chris Wingo from Kyriba's marketing team, and I'm going to quickly take care of a few odds and ends, and then we'll get the show on the road. We have many attendees today, so I placed the audience in listen-only mode. We will be recording today's session, and we'll send you a shareable link via email after the webinar. Our session today will start with introductions by Christine Gilroy, market insights from Wolfgang Kester, and then transition to common challenges with Andy Gage, and then insights, experience, and advice from our all-star panel assembled exclusively for today's webinar. Something to bring your attention to, Kyriba's Currency Impact Report will be available April 9th. It covers Q4 2019 earnings, so please mark your calendars. Lastly, today's attendees of the full live session will be granted 1.2 CTP credits, and we will email out the confirmation letter within 3 to 5 business days, along with the slides and the recording so you can share with your colleagues. And finally, this is a live webinar. We will try to field a few questions at the end, so please submit those via the webinar control panel. And with that, we'll turn it over to today's moderator, Christine Gilroy.
Thank you, Chris, and welcome everybody. I appreciate the difficult times we're all experiencing right now and shuffling around our everyday lives to work remotely and keep our businesses running. So I really want to appreciate the time that you're giving us today to learn some new insights of how the current market is creating disruption. We're going to hear today from the panelists on ways that they have to rethink and reimagine your strategies for liquidity. So let me introduce our experts. Wolfgang Kester is the Chief Evangelist at Kyriba and former CEO and co-founder of FireApps. He has more than 30 years of extensive experience in currency markets and working with the global Fortune 1000 companies and government entities. Kester has been named one of the 100 most influential people in finance by Treasury and Risk magazine and is regularly included in Global Finance's annual Who's Who in Foreign Exchange. Next, Andy is head of Kyriba's FX Risk Management Solutions. As the Vice President of Strategic Markets, Andy advises our corporate clients, consulting firms, and business partners on a wide range of foreign exchange risk management related topics, FX management best practices, and FX hedging. Mimi is Global Head of FX Sales at Barclays. She's responsible for coverage of both corporate and institutional clients. Since 2007, Mimi has been guiding Barclays through the combined rates and FX sales roles and has held a number of management positions in FX sales both in London and New York. Mimi works closely with our customers and our teams to bring FX to reality. Michael is the Director of Treasury Initiatives at Coca-Cola, working on global initiatives around working capital and free cash flow. Michael has spent the previous 10 years focusing on currency risk management and related activities within the Coca-Cola Company's corporate treasury group. He has been part of the Coca-Cola Company for 18 years. Mary has nearly 10 years of experience in corporate treasury, ranging from cash and liquidity management to FX risk management. Prior to joining Duracell, she worked at CommScope for nearly 6 years, overseeing a number of areas, including global cash management, foreign exchange, risk management, accounting, and corporate lease management. Ilya is a senior treasury program manager at Medtronic, a multinational medical technology company with over 30 billion in annual sales. You will have seen Medtronic a lot in the news recently as they donate millions to fight the virus. And also as of yesterday, they made their IP for ventilators publicly available to help with the global production of these critically needed life-saving devices. While balancing all of the new changes in their business, Ilya is constantly looking for new ways to enhance the FX risk management strategies and eliminate waste in the process. So thanks to all of my panel for your insights today. While all of our businesses are different, we are all now going through similar challenges. So I turn it over to you, Wolfgang, and ask for you to kick us off.
Thank you, Christine, and thank you to all panelists. If we go to the next slide, what I'd like to do here is I'd like to really frame up what we've seen before and what we're going to see again. Yes, this is actually a slide, while it says back to the future, that we actually exactly to kick off the Euro crisis conversations. So it's really been talking about and where we're going. I call this the common unpredictable, or again, the common unpredictable, where the volatility is going to come and go, and just chance of knowing where it's coming from and what the impacts are. I've helped corporations for, as you just heard, since about 1985, prepare for, go through, and manage after these sort of crises. So let's talk about what's common here. All I'd be able to identify is what led up to this thing, the calm. The Wall Street Journal, the Financial Times, and others having on the front page, volatility is gone forever out of the currency markets. The C-suites are questioning foreign exchange programs. And as the next part is, as volatility goes down, yep, here it comes, the perfect storm. It hits worse than a hurricane. Why is it worse? We don't know where it's coming from, and it lasts a lot longer. So being prepared for a hurricane coming from anywhere is more difficult than actually weathering a true hurricane. Unfortunately, this calm relaxes people's policies, relaxes actions, and at the end of the day, costs corporations a lot of liquidity and revenues. About less than a year ago, we actually retermed Kyriba as the active liquidity network because it goes far beyond just treasury management systems. It includes really focusing on foreign exchange risk, on working capitals, etc. So as we look at this, and I look forward to the panels talking about this, the common practice is during a storm as everybody becomes more short-term focused, maybe 3 to 6 months. They have to reposition their case for forecasting. And the boards and CEOs are all of a sudden really asking a lot of questions, where this is coming from and what Treasury is really doing. So I'm very interested to hear what Mike, Marion, and Illy have to say about this. So as to the next part, the next slide then is, can you go to that? Perfect, all right. This is not just about the United States dollar. Yes, if you look up what are the most volatile currencies right now, everybody's going to quote dollar sterling, dollar yen, dollar Canada. But really, this is about your portfolio of exposures. Yes, your portfolio of exposures. You likely, if you're a company, certainly S&P 500, you likely have 100 cross-currency pairs. To manually manage these is quite difficult. You will also find out that the 80-20 rule does no longer apply. Lastly, correlation assumptions, and many of you will know that I am not a big fan of correlated VARs, go out the window. So what does this mean for the future? Where are we going with this, and what is the seismic shift that this hurricane, this crisis is establishing? One, we are going from a race to the bottom, which was under trade wars, which we've heard lots about in the last certainly 3 to 4 years, where everybody's trying to weaken their currency to compete in the trade wars to make their products as cheap as possible. And we're going to turn to strengthening of countries' currencies, which is what I refer to as a race to the top, where every country is going to have to value their currency as much as possible to go through what we're going to keep seeing again, budget deficits, hopefully surpluses. So as we go to the last slide, these are kind of the framing up that I'm looking forward to having on this conversation with the panelists to really see how they're going through this right now. But I would like to leave you with this point, that is also utilize this storm to prepare management for the future. What is going to happen after the storm? Should we be laxing it? Should we not do forecasts? And this is a cycle that happens all the time. One, yes, you will be short-term. Two, you will have to refocus and remake the case to management of thinking about forecasts as things become more predictable. I encourage you strongly to think about how to plant that seed during these times. Thank you, Christine.
Thank you so much, Wolfgang. Andy, I'm going to ask you to walk us through the practical insights from the Kyriba client community and talk us through some of the things that you're seeing that are consistent throughout the clients that we speak with.
Yeah, thanks, Christine, and Wolfgang. Thanks for the setup there. Wolfgang and I have been through a number of these currency blowups in the market, going all the way back to the Euro crisis and the Lehman Brothers crisis, and even the ruble. And when we go through this, we do take a conscious effort to reach out to the client base to just see how they're weathering the storm, so to speak, as Wolfgang termed it. And as we do that, we do start to collect sort of a consensus view on some of the practical things that people are working through and applying here. And this is really to help set up the panelist conversation here. But one of the more obvious things, and we saw this even back when we had the collapse of the financial markets, is a lot of the forecasting that the companies have been applying is really, in many cases, fairly irrelevant. We've seen companies back off of long-term forecasting, short-term forecasting to a certain extent, and really just trying to ground themselves in the practical nature of we need to protect the balance sheet. And I think that's a reoccurring theme. And I think you'll hear that a lot today around how to effectively manage volatility in the context of liquidity. I think that's a really big struggle right now, is that balancing act between the immediate liquidity needs that companies are dealing with, making sure that they can be properly financed. And that goes beyond just typical cash visibility, cash forecasting. It's really around how do I set the company up to weather the storm, make sure they have appropriate liquidity available to fund the business going forward. We are seeing a number of companies, once they've got their foundation in place and they're understanding what's happening from an FX and starting to get the liquidity scenarios nailed down, there's a lot of opportunity in this market from a hedging standpoint to not only take the risk out as much as possible, but there's certainly conversations around the view of tenor on hedges and looking at is there an opportunity to be more in the money versus out of the money, given your long short positions there. But I think the other thing, and we've seen this a number of times during even modest spikes in volatility, there's a lot of questions, and I think that's the biggest challenge right now, is that these questions are being laid on top of the typical activities that the companies are having to work through just to manage the liquidity and manage the volatility in the marketplace. So we're seeing a lot of questions from the C-suite around what is this going to do to my P&L? You'll certainly hear that as a part of the conversation with the panel today. What is our true risk, and what are we doing about that? You'll see questions about looking at the markets differently. Not every market is, and I think as Mimi from Barclays comes into this, every market is a little bit different given the liquidity available in those markets, and so there's a lot of questions around that. And I think there's also a lot of questions about what's happening inside of our company. How can we affect change in our risk profile based on better understanding what's happening in the business? So these are some of the key themes that I'm consistently hearing in the marketplace. And I think the other overarching theme that I'm hearing is for those companies that have got good visibility to the exposures, they're in a fairly good position to weather the storm here. So with that, Christine, I think that's a good setup. I want to give the maximum time to the esteemed panel here. So I'm going to turn it back over to you, and let's dive into the Q&A.
Thank you, Andy. That's great. I actually want to appreciate the fact that you brought up that in the cause and the worry and concern that we're all experiencing, that there's also opportunity. So looking at playing the long game and being able to manage the business not only through this, but into greater areas of success. So great to point that out. So thank you for that. All right, so welcome to the group now. We wanted to lead in with each of you and discuss how has your board and your C-suite reacted to the market volatility that was created by COVID-19, and what are the demands and questions that are coming your way? So Mimi, I'd like to start that discussion out with you and what you're seeing at Barclays around managing your FX risks and ensuring liquidity. What are some of those things that are coming up from your C-suite?
Well, I think what's interesting, and good afternoon, everybody, good morning. I think what's really interesting is this focus on liquidity, but then also the interplay of that with all different market types and ultimately foreign exchange as well. The key thing that, it sounds like a very obvious statement to make, but the reason that volatility has increased is because our level of certainty has decreased, and it's decreased across a suite of parameters. Our uncertainty in terms of what the future looks like for any given economy and what the currency risk might look like, but also each company's underlying position has definitely increased. And so to Wolfgang's point earlier, by far the biggest theme, whether it's what we're talking about internally or whether we're speaking to the multitude of our clients that we have the privilege of speaking to every day, is this theme about liquidity. But I can't emphasize enough how foreign exchange, currency exposure, and all of this have intrinsically a linked within that. So, some companies might be overhedged, for example, which means that there is a drain on their liquidity that they need to anticipate and adjust for. Some might be underhedged and mean that it doesn't have the currency in the right or the liquidity in the right currency. But by far, if I were to sum up the conversations that we've had in the last 2 to 3 weeks, the overarching theme is that of liquidity.
Yeah, we continue to hear that as well, as Andy pointed out. Mike, from a Coca-Cola perspective, you guys are a US dollar-centric company, and Mimi mentioned that looking at your exposure globally is important. So what are some of those things that you're seeing from your perspective and what your C-suite is asking you to look after?
Yeah, from our standpoint, it's just as Mimi said, it's liquidity questions that are coming to Treasury from the C-suite and the board. But it's really because, again, Coca-Cola is a US-based company. We report everything in dollars. We need our liquidity to be in dollars, but 80% of our revenues are from overseas. So the first thing that's asked is, where is the liquidity going to come from? And then from an FX standpoint, where's our hedging program at, and what is the impact to our future earnings? Because we need to know that impact to the future earnings in order to understand the impact to future cash flows. So these are the types of questions that have been coming our way, on an hourly basis. I think what has helped us at Coke is, even during times of low volatility, we had established the cadence with our CFO and our investor relations team, where twice a quarter we got together just to talk about currency and where we thought the markets were headed, just so that everybody would have an understanding of our hedging program and what we thought was going to happen in the world. So that's helped out a lot, because we were already kind of in sync with each other before the volatility hit the markets.
And with that level of certainty decreasing, how often are you doing that? Different from the way you did it before?
Oh, right now it's almost a daily discussion.
Yeah.
So we'll see how it goes, as markets start to relax and we realize maybe where the bottom of this is, or whether or not it's a V-shape or a U-shape recovery. I think the new cadence, we'll figure out what that is, but I have a feeling it'll increase.
Probably. Mary, you're now working in a remote environment, which is different for you and most of the staff that you have. What's been the main key focus for you and your executives in hearing what Mike and Mimi are sharing? I'm sure some of this is similar and feels similar to you.
Absolutely. I think from our perspective, we're definitely echoing what Mimi and Mike have said in terms of our focus. So our focus has primarily been on liquidity management. Given our current hedging constraints, we're unable to hedge our exposure. So we're looking at ways to naturally mitigate our balance sheet exposure, as well as just having a solid understanding of how the recent market volatility would impact our P&L. So, those are kind of those recurring questions that we're getting out of the C-suite constantly, in terms of, repetitive analytics and just getting a solid understanding of our bottom line.
Are there things, Mary, that you guys are doing internally to help reduce the exposure, or looking across new ways?
Absolutely. We've been looking at considering settling our intercompany more frequently, reducing our payment terms, and just truly reclassifying some of our debt from intercompany payables to long-term to help mitigate those outstanding payables.
And this is Wolfgang. I just got to say that is such an interesting part for what, when we started FireApps in 2000, 2001, we did a webinar pretty quickly thereafter with Yahoo, went through the same process and got so much confidence from the board that they actually ended up then going to, okay, this is all we can do, that we've exhausted all things to actually have the impacts. Now do we take this to protecting this even further? It's a really interesting point, Mary.
Yeah, and being agile to it, right, Wolfgang, and change, because we don't know where we're going or what's happening. So being able to be more agile and change that as we go along.
Yep.
I want to remind the audience, you guys can post questions while we're in the middle of these topics and discussions. So post your questions in the chat section, and we'll be monitoring those and threading them in the discussion. Ilya, I want to bring this over to you. You guys have a lot going on right now. I see almost daily news press releases for Medtronics and the things that you're doing, and I know that puts an extreme pressure on your team and your role. what are some additional challenges or areas of focus that your C-suite is coming to you with?
Hello, everyone. It's actually very difficult to add anything new apart from what my colleague just said. We also see a lot of similar questions in terms of like liquidity, volatility, what impact on the balance sheet is, what impact on the P&L, what extra steps we can take to minimize this impact, etc., etc., etc. So I would also add that we were asked several times to update our forecast with the new rates, and we basically developed a weekly FX update report. And at this moment, we are capable of refreshing forecasts with different rate scenarios pretty much on demand. It's very interesting to and very helpful to watch the dynamic of the FX market, how exposure profile changes internally, and how forward points forecast changes, etc. So it's very interesting time.
It is certainly interesting for all of us. Andy, do you have any questions that you wanted to field from the audience before we move on to our next topic?
Well, I think one of the things that I think as we get into the next section here is I'm listening to the client, feedback here is kind of a resounding focus on really keeping an eye on the balance sheet. Obviously, liquidity and keeping liquid and making sure you've got the balance sheet to level out there is a key requirement. Companies are going to sustain some impacts to revenue. There's going to be some impacts to costs as a natural function of the business. So as sort of that siege mentality sets in, managing currency in the context of liquidity becomes a really resounding theme across the customer base here. So I think we're hearing a consistent framework here, not just within this panel, but other companies that we're dealing with right now. So I want to move on to this next section here, because I think this is kind of an interesting transition of how the world is changing before our eyes here. Christine?
Yeah, absolutely. Thank you, Andy. I think as the team is implementing the business continuity plans and our remote workforce plan, which is a first for many organizations, I want to think about and discuss how did the use of cloud-based solutions aid in the transition to enable you to manage your FX risk. Not everybody's using cloud solutions, but the panelists have been doing this for quite some time. So Ilya, staying with you here, could you talk to us a little bit about how you guys found that useful for you in that transition and how that enabled you to quickly implement your business continuity plan?
Sure. First of all, when we realized that we will be all working remotely, we quickly got together and decided to basically run a couple of tasks in mind that we will be doing it remotely. And we basically very quickly realized that our team is capable of working remotely very efficiently. However, there were several things that we had to understand. For example, do we have enough data access? It turned out to be that I'm the only one on the team who has Bloomberg Anywhere access. Can we maintain appropriate reviews for example, for SaaS-related purposes? Are we capable of maintaining worldwide 24/7 coverage? So these were the steps that we discussed and created very quickly business continuity plan.
Yeah, and as we mentioned, you guys are under a tremendous amount of pressure being in the healthcare industry, so you really are working 24/7. Mary, yeah. Mary, I want to bring it to you. Can you talk about some of the challenges that you guys experienced, but also you had mentioned some of the seamlessness that it was for you to be able to move into that remote workforce?
I think like many companies, our concern from an IT perspective was around our network security and VPN capacity issues. Having a cloud-based solution has been very advantageous for us in that it was very seamless, right? Outside of just making sure that we had the correct setup for home, monitors, et cetera, managing FX, there was no change in our process.
Okay. Yeah, that's good. We found that similar here, where some of our parts of the business were very seamless for us, and then others we just quickly were able to use that knowledge and then redirect. Mimi, can I bring it to you now and talk a little bit about how you see corporates dealing with banking partners and your business continuity plan?
Yeah, I mean, we've definitely seen our clients shifting and having to potentially adjust behaviors, but in the corporate space, it actually hasn't been too dramatic a shift. Certainly, if I just extrapolate it to the institutional client base, as they started to work from home, interestingly, they did start to do more of their FX activity earlier, trying to ensure that they had visibility earlier in their positions and were able to hedge sort of in a more agile fashion, partly because they just weren't sure whether the banks were set up for an operating environment where effectively, everybody was working from home. I mean, we've not, from a financial markets perspective, there has never been envisaged ever such a big test of sort of everybody's resiliency. But I have to say, it's remarkable, kind of touch wood, how well everything has been working across the financial market system. And also, Asia was very much first in terms of trialing this, whether it's for us or for our client base, and adapting very quickly to that. I do think that, to specifically the point on cloud-based solutions, incidentally, I think that this will really highlight the need for people to factor that in terms of the fact that having a cloud-based solution really does introduce a level of flexibility that people hadn't thought about before. So it will be interesting to see how that evolves over time.
I agree, and how quickly we can get our staff up enabled and from various different points, and as Ilya mentioned, even 24/7 access to it. So they may be shifting their working hours as well, right? So some of the challenge that you get from working at home is that you may not be working in the same hourly schedule that you were before. So being able to leverage the cloud-based solution and enable those folks to shift their timeframes works too. Mike, you guys, in mentioning that you had 80% of your revenues coming from the rest of the world outside of the US, you have a staff that is also global. So what were some of the things that you saw from a business continuity plan as a positive, as well as some of the challenges around mitigating and managing that risk? How did cloud solutions help you there?
I think it's been a benefit. We've used them for a long time, being a global company. Most of our service centers around the world, we're all used to Blue Jeans. We're all used to remote meetings. And in the US, the biggest test was that early in March, we had 2 days where they sent us home and the whole company had to work remotely. So that really, brought to light the VPN issues and some of the discussions we needed to have with other IT partners, and some solutions they came up with very quickly. And so when this happened, it's been pretty seamless. I think the biggest thing around an FX team too, and being a global company, is it's all about data. You need immediate data. So that's what I wanted to say with Kyriba. You guys have got the Fire App solution that we use, and that has helped tremendously from somebody who's working at home. They can pull in all the forecast and go straight to execution and straight to the TMS system, all from the cloud. I mean, it's a big win. And those are the types of solutions, I think, going forward that everybody needs to look at.
Yeah, so you felt ready and able to be prepared and be in a good position. So great. Andy, you had some comments?
Yeah, just kind of a couple of things, kind of extending off the business continuity plan concept here. I think in general, as companies are going through the financial rough patch that is associated with this, is the legitimacy of the underlying businesses. So, Mimi, this is kind of a two-part question. I'll point one to you and one to Mike and the rest of the panelists here. We have seen some sort of lower level FX providers struggle and actually abjectly fail in this environment. As a banking partner, what counsel can you provide to companies of all sizes, not just the major corporates as we have represented here, but some of the smaller corporates that really need somebody to help them lean on the bank's balance sheet? And then for the rest of the team here, following on to that, what's the thought on not just the vendors and suppliers that are within your supply chain, but also in your ecosystem of finance solutions? Is that a key consideration, as I would assume it is? So Mimi, let's start with you.
I think that that's something that people hadn't necessarily anticipated coming into this, and certainly when we look across FX counterparties, you know, broadly, you've got two groups: those who are principal market makers, and then a huge number of counterparties who, over time, have accelerated technology, have brought new things to the fore, and have really advanced our industry in different ways. So I'm hugely respectful of all participants. However, as a the counsel that I would give to corporates is to be mindful about counterparty risk, but also to lean on the banks. Certainly, from a Barclays perspective, I think that our role and responsibility is multiple fold. One is around the point that relationships are most important when the going gets tough, and but also that there is a huge amount of knowledge that we have within our team to help for exactly situations like this. So even when it's a question that might be something that is outside of our organization, I certainly encourage our teams to have a proactive dialogue around that, because these are not straightforward situations to navigate. They are fast moving and they're intricate. So, and that's where really the markets professionals can help. So whether the participants on the call would call Barclays or call sort of one of their other banks, I think that it's really important to remember that repository of knowledge is absolutely there for you to tap into. And a lot of people have experienced not necessarily this specific circumstance, but certainly other examples which they can therefore help you navigate and think through. And really, I see that we're thinking partners as well as strong counterparties and market liquidity providers.
Mike, you kind of brought up the topic of the leveraging the cloud technology and having that. Has there been any discussion or kind of a resounding? It's like we made the right decisions in terms of our software providers, because most of the conversations I hear about people within the supply chain, but knowing you've got people that like a Kyriba that have got a strong VCP in place and are there supporting companies. How does that factor into the organizational IT thinking around cloud providers?
I think it's definitely thought. We think about it, but a lot of times you don't know what your providers have until this type of event happens. And so I think the discussions definitely will be had in the next weeks or months about what providers really succeeded in this environment and brought value versus those that obviously did not have their infrastructure where it needed to be. And I think that's going to be the discussion with a lot of corporates going forward.
Yeah, I think that's good feedback. Christine, you want to move on to the next one?
Yeah, absolutely. And then just to follow up a little on Mike's point, is when you're evaluating the cloud providers, you also are looking at what type of service are they providing, not only just the solution itself, but how are they able to help you through these times, and how much of a business partner can they be? And being able to ask the right questions and look through those things is going to be key and important when you're reevaluating. So bringing it down to the next question here, when did your organizations realize where we were entering into a surge in the FX volatility? And I want to talk about what actions were taken from your initial discussions to all the way through the actions that you're seeing today, and then actions that you're going to be taking in the future as you continue to reevaluate. So I want to talk about those three things, and then maybe start out with Mary here. Could you talk us through a little bit about what types of analysis you did in order to address the initial discussions and the actions that you took?
Sure. We've done various value at risk modeling sort of scenarios within our organization to really understand our potential losses and the probability, obviously, of those losses. I think for everyone that has joined this call, the last 3 weeks have been really unnerving. So for us, it has been very much what are our what if scenarios, and really trying to understand the data and the analytics to make sound decisions now, and hopefully understand our impact by the end of 2020. Additionally, we have just really wanted to understand our cash flow forecast models, the impact that these market volatility is going to have on our cash flow. So it's been very data heavy for us, a lot of reporting and analytics to provide to senior management in terms of where we're going to have our impact on the bottom line. So very data intensive, and just aligning and getting our executives comfortable with the output, right? So that they have a true level of comfort with the data that we're providing.
With that said, then, Mary, how did you gain alignment with the executives? You're showing them the data and what you're pacing at. How did you gain alignment with them? What were some of the things that you did?
I don't know if we have true alignment just yet, to be honest with you. I think there's just a lot of unease still going on through the company as a whole. I think in terms of just getting them as comfortable as we can, is to really show them the model, right? We've been using this Fire Apps tool for a very long time. I think I've garnered their trust in terms of making sure that the data is accurate and really being able to show what we can do in terms of mitigating the risk that we currently have on the books. So I think it's just really making the executive team comfortable and with that level of trust in order for them to be aligned. But I think as we see the changes in the market, there'll still be just that level of unease. I don't think we'll ever get that true level of comfort.
Well, we're not going to for a while, that's for sure. But data does help, and it helps us make educated decisions. Hey, Mike, let's move to you. What was the wake-up call for you guys on realizing that you were entering into a surge of volatility? What was the wake-up call, and what did you do?
It was really the news around oil. The second the oil price crashed, we knew there was going to be a liquidity problem and a run for the dollar. So that was kind of the wake-up call, and that goes back to just everybody in Treasury knowing what their job is and confident in executing. Because I think the morning after that announcement, everybody was in the office by 7 a.m. Eastern time, ready to go. They knew what we had to do. When it comes to the type of analysis, we didn't have to run a lot of analysis because we had our forecast for the year. We knew where we needed to put on more coverage. So really it was the only analysis that needed to be done was how much of that did we really want to cover, given the virus and the other underlying impacts to the economy that were occurring. And so it was really just go in and execute what you know you need to execute. And the alignment with the executives, we've been doing this for over 25 years at Coke, this type of hedging program. So we've gained a lot of trust in times where liquidity is tough, and with the C-suite. So they know the Treasury owns the FX risk and the Treasury is going to do whatever it takes to help alleviate it. One other thing we did with the C-suite and the board last year that I think really helped was we went back and back tested our results of the last 5-7 years against different types of hedging programs, just to prove that what we were doing was not offline. It was actually performing better than most other hedging programs that we could do. So that also gets your C-suite very comfortable. And really, I think that last question about what steps to deal with the surge, it's just always knowing what you need to do under all circumstances. Knowing even when volatility is low, you always need to know if I come in the next day and the world's falling apart, what is it that I need to do? So those discussions need to happen well before volatility ever hits.
You guys must have put that in your business continuity plan as well, then, to be able to handle and understand what those steps would be.
Yes.
Ilya, do you want to comment on some of this stuff from a hedging perspective on your hedging program? How you guys realized that something was going on and putting your actions together?
Yeah, we actually had a lot of different discussions as to liquidity assessments or investment portfolio updates or what to do with funds requests, etc., etc. But most importantly, the first thing that we realized that it was a significant change in bid-ask spread. And after the quick discussion, we decided to take over the whole spot trading activities from our netting center in Europe. And we very quickly implemented the algo trading. And based on the last week trading, we see that it was very successful implementation. We saved a lot of money, and we also, as it comes to the alignment with executive, we also fully aligned with our executive team. The office trusts us. We really have a dialogue with them, and recently we organized a couple of market updates with economists for the executive team.
Mimi, can I ask you to add something in here from a Barclays perspective on liquidity keeps coming up as the common theme. So from that perspective, how do you guys help the clients through these times?
I think it's been less actually in terms of the helping piece has been less about liquidity, but more in terms of helping answer some of these questions. So, you know, to Ilya's point, what you're doing when you're trying to kind of update the C-suite, et cetera, and saying, okay, well, volatility is hit, what should we do? What analysis should we run? What we're trying to do is really help people think through some of those questions and what will be most useful. So Michael made the perfect point around the fact that oil, obviously, as soon as you saw the move in oil, there were going to be knock-on effects in the rest of the market. So really, it's about educating in some instances to the extent that not everybody has sort of large teams, treasury teams, and a lot of manpower in order to think these problems through. Certainly, that's what we try to do as a team. Here, what's been really interesting is that this wasn't, you know, the way in which we've kind of posed the question here around entering a surge in FX volatility. What's been really interesting over the last few weeks is that it wasn't a one-time thing. This didn't sort of happen and then, you know, everything became a little bit more predictable. There have been multiple things to focus on during the last few weeks. And so just trying to make sure that people are focusing on the right aspects, whether it's, you know, broadly the oil and dollar, or then what was happening with dollar yen, or certainly a focus on sterling when you started to have sterling specific underperformance. You know, it's trying to help with all of that, but certainly also trying to help with some of that analysis. And, you know, we can, Mike made a great point around sort of the Kyriba FX risk management technology solution, but I think that that's part of it, right, is knowing what tools do you have to hand, how can you use them quickly, and how can you get that visibility when things are changing quite so rapidly. You know, for Ilya's team to be able to make that decision with that speed, because it is a very quick decision to change all of your trading from one type to another, you have to be very confident about what is happening within your treasury function, and you've got full visibility as to how you can have an impact.
Yeah, so this Wolfgang, one thing that I found very interesting, it comes right along the lines of what Ilya just said, and you, Mimi, is I go back to Brexit, and during Brexit, that weekend thereafter, my phone lit up constantly asking about what are the short-term and long-term impacts of foreign exchange and what are we supposed to do, and that typically came from the CFO, CEOs, but also quite a few board members. And I think to the points that also Mike made a little bit earlier is the questions that I gotten over the last 2.5, 3 weeks all are asked about liquidity. How is foreign exchange impacting liquidity, and does it really matter? It doesn't matter what it is. And I think it's really important to actually then show how foreign exchange is a significant part and likely the largest financial risk that corporations have, and to have the data available to show that, how it's impacting all monetary assets and liabilities of companies, just super important. And I think that that's what I'm hearing here is, again, board members are asking the C-suite who are asking Treasury, and it's good for Treasury. I'm very happy to hear that everybody on this phone was very prepared for that, and hopefully most people were prepared. If not, we can help on that. But at the end of the day, it is about liquidity, and liquidity being impacted by foreign exchange.
Yeah, that's a great point, Wolfgang. You know, when you see that you have the data and being able to analyze that and bring that forward to the C-suite, I think that's what Mary was talking about and what they were doing, and doing that on a more regular basis, it calms people down and brings us to a different level of understanding. And it's really important for us to do that so that we can move into the next steps on how do we continue to respond.
As Mike said, daily, right? He's getting daily. Everybody, I think, on this phone is getting this daily right now.
Yeah, and that may not change, right? That could continue to go on and be something that's the new norm, and that may not change for quite some time. Does anybody else want to add any discussion before we move on? I'd like to make sure that everyone's had a chance to add commentary. And Andy, do you have any questions coming in from the audience?
No questions yet, but certainly encourage people to submit those. I think this next section will probably brew some curiosity and some questions. So audience, please submit questions, and we will definitely incorporate them into this next section. I think this is a very interesting next agenda item here.
Thanks, I agree. So what we're going to talk about now, and I encourage also the panel to open freeform questions as well. What changes have been made to your firm's FX exposure management program and your focus? So I think earlier on we had a discussion, and one of you mentioned that you always think that somebody else is doing it better, and so you're reevaluating and looking at what you're doing, and that's what I would like to understand is, for the audience's perspective, is how are you defining that FX exposure, and what are your hedging approaches, your internal efforts to reduce that exposure? What are the things that you're doing, and are you changing your focus and realigning that? So if we could start out, Mimi, on this one, I'll start out with you, building upon those last comments that you had. How can you help the companies reevaluate this, and what are you guys doing there?
Well, I think what's really important is to almost have the acceptance that the market has moved, and so that there needs to be a recalibration. Clearly, it's not something that any of our panelists are suffering from at the moment, but unfortunately, it is normal within a corporate landscape, particularly if you've had such dramatic moves, that there is a little bit of a reluctance to necessarily recalibrate to now. So I cannot encourage everybody enough to just rebase and rebudget and reforecast based on the information that you have now, not based on historic information. And by that, I mean that clearly market rates have changed. Volatility has also changed. But I'm also conscious that clearly the underlying for almost every single business, regardless of industry sector, has adjusted as well. So that, I think, those things are critically important. The other thing, sort of as a broad statement, and then I'll listen to sort of what the other panelists say first, is in markets like this, and certainly if we continue to see uncertainty both on the underlying business side, but clearly on the risk management side, is the need for us to be agile and to have some sort of flexibility within what we do. So, the formulaic systematic treasury policies that might have been appropriate a couple of months ago when we were in a much more benign market environment may not be appropriate now. And I think what's interesting is allowing yourself to actually reevaluate based on the current conditions, but also to allow the business from an underlying perspective to operate. Fundamentally what all of our panelists have talked about is the opportunity to be flexible here and to adjust. And that can be done in many different ways. It can be done through the way in which you hedge, tenors, etc. And I'm sure that some people will talk about that. But it's if you take away just two things, it's one, which is recalibrate to today, sort of not necessarily hunkering on some previous rates or your view that currency may revert to a previous norm. And secondly, is trying to retain some flexibility and agility as we adjust within this new market environment.
Mike, can you talk us through a little bit from a Coca-Cola perspective, what you're doing with your hedging approaches and how you've changed or modified that? Because you mentioned some of these things that you are recalibrating as well, and you're relooking at things. So how are you guys handling that going forward?
I think really there's two parts to it. There's our program, which is focused on revenues and earnings, and then there's the balance sheet program. And the first one, our program that really focuses on our future revenues, it's really what Mimi mentioned, which it's being agile. We had coverage on, and then the market moved. And as Mimi said, we're in a new place. We're almost at a new base. So the idea then is to kind of look at your coverage, and if you're where we were using, forwards as our coverage, for example, maybe going into options where the future expectation is maybe we have hit the bottom and the markets will start trading on news. And if there's any opportunity, maybe we want to capture that, and just kind of changing what sort of structures we're using. For the balance sheet, it's a little bit different. We still believe in using a rolling type program that most corporates use, but I think in the balance sheet, your biggest issue is always forecasting error. And right now we are in extreme uncertain times, and that's why volatility is so high, that I think we've kind of made the decision that going forward for a while, we're just going to hedge actuals because trying to forecast the unknown it's almost an exercise that's going to take a lot of people and a lot of energy and still not produce great results. So we are more comfortable just hedging actuals in the balance sheet going forward for now.
Interesting. I know, Andy, you guys had some conversations with some of the other customers as well from that perspective where they're not so heavily weighted on the forecasting, but looking at actuals. Do you want to add some comments there on what you've also seen from others?
Yeah, I think the focus on the actuals is a very consistent theme through a pretty large swath of our customer base. I think the other theme that I'm seeing out there, and we've talked to a number of companies, is increasing the frequency of the monitoring of the underlying exposures as well as the rate changes in there. Really realizing not everybody's on a daily rate within their ERP systems. They're still wanting to make sure they understand how the business is changing because it is so dynamic. But those companies that are certainly on a daily rate have an added complexity in there because the business is changing and the rates are changing at a momentous pace right now. So we've seen companies go from every other day monitoring to daily, and sometimes the intraday monitoring and adjustments to the exposures, especially as things peak there. So just having that flexibility to increase that frequency of monitoring and adjusting is pretty critical in this situation here.
Absolutely. Mary, you guys, with the data and the information that you're gathering and you're combing through, what are you guys doing around your hedging approaches or internal efforts to reduce that exposure?
Sure. Our efforts are definitely internal. Given our hedging constraints, what we do here at Duracell is just looking at it holistically. So we've increased our sort of analytics to weekly. So given whatever the market changes, we're doing a weekly analytic based on current market rates at the end of the week of where our results may end. I think from our organization, it's very critical for us to be able to perform that modeling and get it to the business as we enter our new forecast period, right? So that the business can make the decisions necessary and build that into their forecast appropriately. I discussed earlier our ways of mitigating our balance sheet by, considering the frequency of settling our intercompany. Additionally, we're looking at the cash that we have on hand as well, right? We want to reduce cash where the markets are more volatile in sort of a natural way of mitigating risk and for unable to hedge. So our approach has been very strategic. We're definitely looking at sort of our future outlook at a weekly basis and just getting a solid understanding and getting that necessary information to our executive team.
Yeah. Sorry, some of that we got a little background noise, so I apologize for that. But Ilya, based on some of the stuff that Mary's just talking about with how they're looking at their longer term views, you guys are still hedging at 100%, you had mentioned to us. So can you talk to us a little bit about if your hedging approaches have changed or how you're looking at that new exposure here?
Yeah, we're still hedging at about 100%, and to Nina's point, I really like sorry about that. I really like your point on flexibility and recalibration. Obviously, it is impossible to reduce an exposure at the snap of a finger. However, under current circumstances, when we are dealing with high volatility, low liquidity, and high hedging costs, we need to pay extra attention to the exposure management. And for example, we asked our local finance teams to take another look before submitting their sales forecast to us. We reminded accounting to clear accounts to prevent unnecessary hedging and hedging costs, and in turn hedging costs. We reviewing hedging tenors and what is this beneficial at the moment to hedge, for example, balance sheet 3 months forward or just 1 month forward, and things like that. So basically, we want to review every little steps, every little component that under normal circumstances has, low to medium importance, currently it needs to be carefully evaluated in order to achieve successful and efficient hedging. So yes, we are hedging at still hedging at 100%, but paying extra attention.
Ilya, I think that's really interesting. And I'm a big fan of looking both inside and outside how to manage that. And Mike, you in our conversations last week mentioned that you guys were also looking at tenor, but also taking a hard look at your intercompany loan portfolio. You care to comment on some of the things you're thinking about from a tenor standpoint?
Yeah, in regards to intercompany and tenor. Oh, sorry.
Yeah, go ahead.
Ilya.
Go ahead, Mike.
Okay. Yeah, we had been looking at it because number one, we need liquidity, so it's making sure that the intercompany balances that were outstanding were paid as soon as we can get them paid. But it's also, we are in, so when you're talking about countries like Africa and Southeast Asia, we have a lot of intercompany with countries that have restricted currencies. So in times like this, when there's a dollar shortage, it was re-looking at a lot of these balances and working with accounting on how can we reclassify these balances long term so that they're not remeasuring anymore. And that's one way you can definitely reduce the volatility that's going through your P&L. If you have intercompany balances out there that in times of stress, I mean, if they're not going to get paid off in the near future, then work with your accountants and try to get them reclassified where the remeasurement will stop.
I think that's a really good point. I know we're getting close to questions, and I'd like to start these off a little bit with, one of the reasons that Mimi, we asked you to come on there is you've gone beyond what many banks are doing and trying to create the liquidity and all the good things they're doing, and really focused on corporations to the point that you're actually offering to help them beyond what banks are doing. Could you kind of expand?
Yeah, of course. I mean, many participants on the phone, particularly if they were at Kyriba Live, will have heard of the partnership that Kyriba and Barclays have around foreign exchange. For me, as I mentioned earlier, and for our business, it's incredibly important that we lean into the relationship with our clients now and potential other counterparties now more than ever, because we know that we have professional knowledge that we can share. We understand that these are difficult times to navigate. And we think that we can certainly help our clients navigate that in a multitude of different ways. The one thing that I can't necessarily help our clients do is gain better visibility on the underlying exposures. So we've had a partnership for a while, and certainly when you're thinking about liquidity and kind of pulling back from certain things, I'm sure some people wondered whether we would step away from partnerships like this because, we'd want to make sure that we save our resources, but it's actually the opposite. We're very much leaning into this partnership and offering up some of our some counterparties who have relationships with us or with Kyriba to be able to trial the software. And it's even more pertinent now to do that and have it funded by Barclays for a year, because I'm conscious that a lot of our clients will not have the opportunity now, certainly, to budget for this exercise. But if anything, this market has taught us that, understanding what those exposures look like and being able to manage them is more critical now than it was certainly last year and probably the year before. So I feel very strongly about it. We're very much here to help. I think that we should try to do that in every capacity possible. And, I reiterate what I said before, we're thinking partners for our clients and for corporates out there first and foremost. But if we can help with the technology side as well, through this partnership and help people navigate and really get those exposures so that then we can help with the thinking, that's all the better from my perspective.
I think that's pretty large, and hopefully a lot of people have recognized what Mimi said there is really going to buy technologies that Barclays has from us and then willing to share that with people who are looking to do good, solid business with Barclays and not having to look for budget. I think that I'm hearing that constantly, like, well, is my budget frozen or not? And quite frankly, I think a little bit of like, you're walking through the desert, since I live in Arizona, you're walking through the desert and somebody's going to offer you water. I would take it, quite frankly. So I think it's really helpful, and I think it's a really great step that is very strategic and really thinking about corporates more. Thank you, Mimi.
No, thank you both. I want to just, for those that are out there, Barclays is offering the program that has the way to assist you. If you don't have the budget, they're willing to fund this for the first year so that you can get into the FX world with us. So reach out to Barclays or reach out to Kyriba if you're interested in that program. Andy, I'm going to let you wrap this up with the practical experiences and thoughts from your Kyriba customer base, and just to sum up what we've heard today. And then again, thank all the participants for joining us on this session, and reach out to any of the participants on this panel if you have any additional questions. So Andy, why don't you wrap it up for us?
Yeah, I think the resounding commentary has really been around managing liquidity, managing your FX exposure in the context of liquidity, and really reinforcing the strength of the balance sheet to weather the storm here. There's been a lot of practical advice here around really understanding the exposures. You can't manage through a crisis like this without really having a firm grasp of the exposures. We're definitely seeing people pull the time horizons shorter, moving away from forecast as much as possible, leverage the actuals as much as they can, increasing the frequency of monitoring. Just keep your finger on the pulse of the business and the currency market so you can also respond to those questions out there. One of the things I'm a big fan of is also look inside. There's a lot of things that you're hearing from Mary and Mike and Illy about trying to settle intercompany faster or reclassify intercompany loans. That's a great way to take some of that exposure off the books without necessarily have to take on the cost of hedging. And I think Mimi's point is so fundamentally strong right now around you really need to rebase your long-term budget and cash flow expectations there. That the world has changed tremendously there. And then the other thing is the companies that have invested in the cloud technology so they can work from home, that have their arms around the exposures, they're actually in an enviable position right now to do things like Mike and Illy are talking about. Is how do I look at this from an economic standpoint versus just a risk management standpoint? How can I look at being in the money potentially on some of my hedges? That's a really enviable position to find opportunity in a market like this. So, with that, I'm going to turn it back to you, Christina, to take us out, or Chris, if you're going to take us out. And there are a number of questions here, so if you still have questions from the audience, feel free to submit, and we'll try to follow up individually afterwards. Thanks so much.
Yes, thank you, Andy. And thanks, participants. This concludes our discussion today. Again, we'll answer the questions that you posted as best we can and send those to you directly. Things are going to continue to change, and we want you to know that as your business partner and folks on the phone, we are here to help you change with it. So thank you all for doing your part, and we look forward to having further discussions. This ends the session, Chris.